So all this means is Uncle Sam needs more and more tax revenue. He's going to continually lower the bar to whom he defines as being wealthy. So you're here, you've done, or it looks like you will do quite well with your retirement savings and qualified plans. So you, my friend, have a huge bullseye on your wealth, okay? A big tax bullseye on your wealth. So it's great that you're here, but you also need to take action, make the moves needed to make sure that you don't get stuck paying more than your fair share of taxes. All right. So hopefully we'll help you with that today, all right? So let's kind of get rolling on this. So our assumption is going to be, and these are hypothetical assumptions, that we've got a couple that's married at age 65 and up, and they have between $500,000 and $1 million in their 401k IRA, their qualified money, all right? We're going to assume that they're getting Social Security of $30,000. We chose that because the average Social Security check's about $15,000 a person. The standard deduction in 2021 for a married couple age 65 and older is $27,800. Okay, so where does that come from? Well, the married filing jointly standard deduction is $25,100, but since they're 65 and older, they get $1,350 per person in an extra standard deduction, and they would get that if they were 65 or older or blind. Okay. And that's important here, and I'll get into why the standard deduction is important, really important here in just a moment. We're going to blow through the 10% tax bracket. It's $19,900 wide. So we're trying to figure out where the sweet spot is on withdrawing income based on having $500,000 to $1 million in your 401k IRA. So that gives us a total income of $77,700. Okay, so but we're only taxable on $73,200, and I'll show you why in just a second. So the $27,800, that's standard deduction. So look, most people that are retired don't itemize, right? And the 2017 Tax and Jobs Act minimized that number even more, to reduce that number even more, because fewer and fewer people are itemizing. If you happen to itemize, then your number would be higher than that 27.8, and that's a good thing, because that deduction, whether it's standard or itemized, is basically the amount you're able to pull out income tax free. Now, with Social Security income, it's not quite that way. If you go 30,000 and 20, because you would end up paying some tax on there, not a lot, but some. But it does. Excuse me. It does make sense to try to maximize that standard deduction or that deduction. We're going to pay $1,990 in taxes at 10%. All right. Now, the reason why we pushed the Social Security into the 12% tax bracket was because we're not taxed on every dollar of it. The most you're taxed on is 85% of that. So that's why only $73,200 is taxable of this, okay? So $25,500 is taxed at 12%, so we're paying $3,060. So the amount of taxes you pay on $77,700, this is federal taxes only. We did not include states. States differ so much. You could live in Florida and not have any state income tax. You could live in California or New York and have really high state income tax, okay? Your total federal taxes are $5,050. So that means over 10 years, you could pull out $777,000 and only pay $50,500 in federal taxes. Then over 20 years, you could pull out $1.554 million and only pay $101,000 in taxes. So people get hung up on tax brackets. So, Kurt, you're making me pay taxes at 12%. Well, your effective tax rate is only 6.5%. So if I can pull $77,700 out at an effective tax rate of 6.5%, I'll do that all day long. Wouldn't you? And if you watch any of the other videos, when we have more money, these numbers are higher, but the effective tax rate is still amazingly low. Not that low, but it's still amazingly low. So think about this. Life expectancy, if you reach age 65, it's about 22 to 23 years for a male, and it's around 25 years for a female. And actually for a married couple, if you both reached age 65, there's about a 50% chance one of you lives to almost 94. So there's a lot of time that we need to be planning for in retirement. So if we can eliminate future income tax liability, would that help make your dollars, your money last longer without any additional risk? That's the question we ask on this, all right? We think future tax rates are going to be higher. They could be much higher. Now, granted, if you're making $77,700, there's a chance that you may not fall into that getting taxed more, but with $500,000 to $1 million in a 401k IRA type thing and qualified money, you could fall under that. We don't know, but we want to plan for that. Your tax rates aren't going to get lower, I can tell you that. So it makes sense to see if we can effectively and efficiently pull out money. So including your Social Security in retirement, do you currently or do you plan on having less than $77,700 in gross income? And I think that probably a lot of folks with 500,000 to $1 million will have that. Okay. Let's assume you've got around $600,000 in your 401k or your IRA, and you're living off $50,000 now. Okay. So would it be beneficial to withdraw $27,700 of fully taxable money if it only costs you basically $5,050 to eliminate taxes on that money forever? Would that make sense? So in 10 years, you'd have paid $50,500 on $277,000. In 20 years, you'd have paid $101,000 in taxes on $544,000. So if you're concerned with higher future tax rates, and you wouldn't be here if you weren't, right? Why wouldn't everyone do that? So how about this? Let's assume a retired couple's living on $30,000 just beyond their Social Security. There's folks that do that. Let's assume they have $600,000 in qualified money. At age 72, they have to begin taking required minimum distributions, which would begin at $23,438 and move up, okay, because it goes up in percentages pretty quickly. Why not, instead of waiting till 72, why not start now and eliminate those taxes at a rate that you control, okay? Plus, we can give you there's a big bonus with this strategy. So why wouldn't you take out an additional $23,438 if it only costs you $100 a year to eliminate taxes forever on that money? Right? Now we could do more, but this was just kind of a minimal type thing here. If you allocated that $23,438 into an advanced strategy that safely bundles, because we want to protect our money, we want to grow it, but we want to take forever taxed money, pay the taxes on it, and create never taxed money. All right. So if we could safely bundle it into a tax-free wrapper, where in 10 years you've converted $234,380 of forever taxed money into never taxed money. That $23,438 a year for 10 years created a total of maybe, let's say, $280,000 in face amount of death benefit. So after 10 years, you got $234,380 in tax-free cash and around $514,380 in leveraged death benefit. So that $234 plus the $280 creates leveraged death benefit of about $514,380 in 10 years. Okay. And it's got the ability to help cover long-term costs without wasting any long-term care costs without wasting any premiums. And I'll get into that a little bit more here. So over 20 years, haven't you figured out a way to eliminate taxes on $468,760 for only about $2,000? Okay, so when you die, your heirs get reimbursed for that $2,000 in taxes. Ooh, I know that's going to break them, right? So they got all that fully taxable money without paying 1 cent of the taxes out of their pockets, and they've got up to $280,000 of money available if you need long-term care. If they've spent all of the if you have spent all the $468,760. So basically, this works out, and I'm sorry, I'll get into it a little bit more in just a minute. So consider you never met me. At age 85, one of you needs long-term care. Or actually, let's say the last living spouse needs long-term care for the last 2 years of their life. So you realize that 40% of the people that died from COVID were in nursing homes. So would you ever put someone you love into a nursing home if you didn't have to? So we're looking for strategies to help keep people from having to go into a nursing home. You love yourself, don't you? Wouldn't you prefer your care was handled where you control it, probably in the home? I mean, that's where I would want it. I would think that's where most people, if they had the money, they had the wherewithal, they would want their care to be handled in home, right? I think that's where most folks would. Now let's assume that cost $80,000 a year and it took 2 years. Okay, so it used up $160,000. If you hadn't met me, it had used $160,000. Actually, it's more than that because you had to pay taxes on that additional $80,000. Of that $600,000 that was in your 401k or IRA, right? But if there was $468,760 in cash value that has a $748,760 face amount total, leveraged face amount of death benefit, assuming you use $160 of that cash value over the last 2 years of care, wouldn't you still have $308,760 in cash value and have replenished the $160,000 with that $280,000 at death by the remaining face amount of the death benefit? Okay. Do you know anything in the world that can do what I just described? I got a surprise here also. If you don't need specialized care, you didn't waste 1 cent on the long-term part of this. And that cash value could also supplement your, you can spend that cash value however you need it. So let's assume you spend all the cash value, you've got $280,000 sitting there, and you needed $160,000 to pay for long-term care. You can tap into that death benefit, pay that $160,000, then your kids are left with $80,000 after death. Okay, so whatever is left from whatever you didn't use in the cash value or didn't use in the death benefit, okay, passes to your heirs income tax free. And in this situation, unless they drastically were to change the estate taxes, you wouldn't be paying any estate taxes on this either. So this is cash value life insurance. So maybe a cash value life insurance policy isn't as bad as they'd like you to believe. I mean, from what I've explained, is there anything wrong with this? It's actually pretty good, isn't it? Haven't we protected your money from loss? We've created tax-free growth ability in it. We've multiplied your dollars. We've given you extra money in case you need it, okay, for long-term care, right? And if you don't, it still passes all to your heirs, income tax-free. More than likely, it would also be estate tax-free. So what else does that? Does your 401k? Does your 401k magically create an extra $280,000 in long-term care / death benefit? No. Can it protect you from is it guaranteed to protect you from not losing any money? No. Is it going to grow tax-free? No, it's actually all taxable. The more money you have in there, the more taxes you got to pay. So maybe cash value life insurance policies aren't as bad as they'd like you to believe. Okay, so we've met our goals with this. All right, it may not be as much as you thought, or it might be more than you thought. I don't know, but I'm betting you hadn't thought about this. All right, so let's change this up again. So let's say that you need to live on $70,000 of that $77,700. You can still pay the extra $770 in taxes. So it's about $69.30 after taxes. Fund a life insurance policy that will help out with long-term care if you need it, or as a way to leave legacy with the loved ones after you're gone. Now, this might create $75,000 in face value, but by the age of 85, when you might need some care, there's a chance that the growth in it could give you more than $200,000 of total money available to pay for care if you need it. And whatever you don't use passes to your heirs income tax free. So even if you don't have a whole bunch of money to put into it, okay, you don't have $28,000 or whatever we talked about, $24,000, 23 and some change to put in it every year, okay, it still can give you great value. Right? So there's some benefits here, significant benefits to it. We didn't really even get into the additional income that it can create, the fact that it would likely grow and be more money in there. I mean, it's an amazing tool. We call it the Swiss Army knife of retirement planning. We think everybody should have at least some of their money in it because it does so many great things. All right, so basically, what we want to do now is offer you a 30-minute hassle-free strategy call. You can book it. You can find it. You can book it on our online calendar. It's below the video here. You'll just find a time that you get 30 minutes in front of your computer. Book it, and we will email you a link to our secured video conference page. We want to make sure that no prying ears or eyes hear or see into that, because you'll end up giving us a little bit some financially important information. But let's get you on a strategy call. Show you how this might look for you. People, and you can ask me all the questions you want. I know cash value life insurance has a bad reputation, but it's and nothing's perfect. There are some downfalls to it, and we try to do everything we can to minimize those pitfalls. And we'll certainly explain that in more detail to you in that call. But it's something that honestly everybody should have some money in. Maybe more money than what they would actually think, because it has so many tremendous benefits. So just wanted to give you a kind of a quick little deal on another strategy to think about. So before you dismiss this, let's at least have the strategy call. And you have the choice at that point in time to not do anything. Try to do it on your own. Go back to your current financial person and ask them to do it, although if they haven't shown you this, they don't know how to do it, would be my guess. So I don't know. I'm sure that that's not the person that you'd want to do that with. And then full disclosure here, our favorite option would be ask us to help you. We'd be happy to do that, and we'll explain how that would work on that strategy call if that's something that you want to do. So, but go ahead and if you have any questions, you can call. My cell number is the best one to get me at, or email me. But really the best thing to do is just go ahead and sign up for that strategy call by clicking on the calendar below and finding 30 minutes when you be in front of your computer. And let's get that thing booked and get you talking and about this and see how it might help you. So thanks for tuning in. Really glad you could be here with us.